Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, and welcome to the latest installment of our InvesTips podcast series. Today, we're going to talk about managing volatility and how important this is to achieve financial success. To discuss this, I have here with me today Mr. Steve Brice, our Global Chief Investment Officer. We'll be talking about potential sources of volatility, strategies for managing volatility, and how our SC Wealth Select framework can help you on your journey. Steve, so before we start getting into the details, how do you think about financial market volatility and how do you prepare for yourself?
Okay, thanks, Michelle. Well, I guess the starting point is to understand that market volatility is something that we have to expect. We don't know where, when, or how severe it will be, but volatility is an inevitability, and this should be factored into your approach to investing. So if market volatility scares you, so just temporary fluctuations in the valuations of your portfolio, then you should factor this into your investment approach and tilt towards assets with lower volatility. You understand that will lead to potentially slightly lower expected returns, but the key is to remain invested, right? So if you're less concerned about these temporary fluctuations, then you can tilt towards assets that have much higher expected returns, but obviously at greater risk of temporary loss. So equities would fit into that category. I guess the key really is to be honest with yourself when setting up your portfolio before volatility hits. And this is something I see all the time. People being very heavily exposed to equities during a market rally because there's a fear of missing out. But then obviously they get stressed when equities start falling. So this obviously risks you selling after market declines. That not only locks in the losses you've made, but also you miss out on the eventual rebound. So that's something that you really want to avoid. So I guess if you're just starting on your investment journey or you've been burnt before, the best thing to do is probably to err on the side of caution to start with. And then if you realize that actually you're becoming more comfortable with short-term fluctuations, you can gradually add to your equity allocation as a percentage of your overall portfolio.
Okay, so let's talk about different sources of volatility. The first few years of this decade, we have seen some significant bouts of volatility already. So what have been the different causes of volatility so far?
So I guess at a high level, we see three main sources of volatility. So, and they are significant changes in the outlook for monetary policy settings, geopolitical or black swan events, and recessions. Now, sometimes these can overlap. They can be intertwined. But most bouts of volatility have at least of one of these in the environment that creates that volatility.
Sure. So perhaps let's go through these one by one and think about the market implications.
Okay, so maybe I'm going to start with geopolitical or black swan events. And it may seem strange, but in some ways, these are the hardest to analyze because they're usually unique in nature. It's not something that you can point to in history and say, we've seen something very similar to this. And then because it's difficult to analyze, it's easy to get your head in a spin about what to do as an investor. However, if you look at major geopolitical events over the past 80 over years, most events have either had a very minimal or short-term market impact. So we've looked at 14 key geopolitical events since 1940, which was the Battle of France. And 8 out of those 14 cases, the stock market returns were actually positive 3 months after the event. And actually, if you strip out the first 2 of those, which are the Second World War events, it becomes 8 out of 12. So it's around 2/3 of the outcomes you see positive returns on a 3-month basis. And then if you look on average, the market sold off around 2% in the first week and then started recovering and getting back to roughly break even after 3 months. So, this is it suggests that these things generally have an impact, but they're generally short-lived and relatively minor. And that's especially the case if you don't have a recession. So black swans can happen with a recession or without. But if you strip out those that had a recession, then the stock market more than recovered its losses actually within 2 months of the event happening. So, and if we look at the recent military exchange between Iran and Israel, actually it's something similar is playing out here. So we saw stocks were down around 3% in the first week, But then within 3 weeks, they'd already eradicated these losses on the way to making record highs. So, recent history suggests that this is actually a reasonable way to look at geopolitical or black swan events.
Got it. So just now you've mentioned about geopolitical events and some of the black swan events. What about monetary policy tightening?
Okay, so this is often most people focus here on the US. It's the important one, but what the most extreme example I guess we've seen was in 2022, so very recently, and this was intertwined with a geopolitical event as well, right? So we saw the Russia-Ukraine conflict. And this led to a severe supply shock and inflationary pressures. Now, central banks initially labeled this famously as transitory, but then they came to realize that it would need to respond by tightening monetary policy or raising interest rates pretty aggressively. And this led to losses for both equities and bonds, pretty sharp losses, actually. So peak to trough, the US equity market fell over 25%. Bonds fell slightly less, but still fell pretty sharply, high teens losses at some point. So that's actually led us to describe 2022 as the second worst year for investors in over 150 years, only surpassed by 1931, where the stock market fell over 50%. So now normally policy adjustments don't create this level of losses that we saw in 2022. Usually it's in a normal cycle. The central bank will signal it's going to tighten aggressively. We'll see some short-term weakness in markets, and that actually does the tightening for the central bank. So you get this sort of natural normalization. But it can still buffet investors significantly in the short term. I guess what's interesting here, though, again, is there was no recession involved, and so we've seen in the 2 years since the sell-off in 2022, we've seen global equities going on to make new highs already, and since October 2022, our balanced allocation has actually risen almost 25% in value. So that's obviously in under 2 years. That's a pretty strong rebound. And so those that resisted the urge to sell in 2022 have been handsomely rewarded.
Got it. So just now you have sort of downplayed the severity, or in other sense, longevity of the market weakness caused by monetary policy tightening or some of the geopolitical events. But you have also caveated both by assuming no recession cases. So I guess the implications of a recession is much greater on that.
Okay, so you picked up on the caveats, right? So yeah, absolutely. Recession generally has a much greater impact on the stock market and performance of diversified portfolios. So just to give some context, in the last 7 US recessions, the average drawdown in US equities has been over 30%. And on average, it lasts around 10 months, right? So this can be even worse if you have what we call a balance sheet recession, which is usually characterized by a large buildup of financial excesses. So the best example of that was the housing bubble in 2007. So balance sheet recessions tend to last longer and are deeper in nature. So obviously your patience and confidence can be severely tested during these phases. So the 2008-2009 global financial crisis gives a sense of what can happen with US equities at that time falling over 50% in a period lasting over a year. So that was, certainly in my career, the most severe sell-off we've seen from an equity market perspective and from a size perspective. Now, at times, it actually looked as if the global financial system was going to melt down. I remember I was in South Africa at the time watching, and it really looked pretty scary. But what saved the day was massive fiscal and monetary policy stimulus, as well as the decision to bail out the banking sector. Policymakers basically stared into the abyss and decided to do whatever it takes to avert the crisis from spiraling further and further out of control. And that led to a very, very strong rebound in the stock market. So the stock market rallied from March 2009, rallied by 65% by the end of that year. So a very, very sharp rebound after what had been obviously very sharp losses beforehand.
Okay, so that sounds pretty traumatic period for investors. Do you have any tips for them?
Yeah, so I guess I'd go back to what I said at the start, right? So we have to know that things like this will happen at some point in our investment career, right? So we will see recessions, we will see financial crises. Hopefully, not too many of them, but they will happen. So it's important, therefore, to understand this, and that helps you prepare for it, not just in terms of how you invest, but also emotionally, right? Because you can look back now at the global financial crisis and say that was a huge buying opportunity, but it wasn't obvious at the time exactly when that point would be. So it wasn't like you walked in March 2009 and said, today's the day I should be putting all my money back into equities, right? So it is very challenging to do it. But if you can build a portfolio with a sense of what the maximum drawdown might be in different historical scenarios, then while it's not precise, it will give you an idea of how much risk to take, right? So if you say, okay, I'll put this portfolio, and you can work with your Standard Chartered relationship manager to do this. You say, okay, if I have this portfolio, what's been the drawdown we saw in the global financial crisis with that type of portfolio, or through COVID, or through 2022, and it will just give you some sense, to see what might happen at some point during the holding period, and help you err on the side of caution. We really want to avoid being a forced seller, either due to financial needs or emotional needs. And I guess on the financial side, it's also important to understand that portfolio losses do not happen in a vacuum. Right. So, it's very easy to look at the financial market without thinking about what else might be going on in your life. So you might be fearful of losing your job. So that, again, should be factored into how you invest. So if you're in a very cyclical industry, then maybe you should have less risk in your portfolio because the risk of losing your job would be higher. But if you're a teacher, your risk of losing your job may be much lower, meaning you can take more risk in your portfolio. And so these things should be thought about ahead of time as well. And maybe a couple of other strategies you can think of. One of my favorite is having some cash on the sidelines to invest, so that you can focus on the financial market sale that's going on around you, rather than necessarily just the loss on your investments that you've already made. So that's something that I certainly employ. And then a final thing to think about is having what we call a pot of money approach to investing. So you have one pot that has a particular goal in mind, and then another pot that has something else. So you could think about retirement. You have a long time horizon. You can take more risk in that pot. But if you're looking at either a down payment on a property or your kid's education fund, you may have to take less risk. But just going through the process of thinking like that, having the different objectives, can help you understand more the trade-offs and prepare you mentally for the inevitable volatility that you're going to see. So I guess that's where SC Wealth Select can come into to help you. So we start with, what's the purpose of wealth? Right. So is it something that's money that you need very in the near term? So the today, is it something that you're needing more for a longer term, whether it's to retirement or tomorrow time horizon, or is it even actually forever? Is it for next generation, for charitable contributions you want to make after you pass away? So that can give you a context of saying those pots of money can be very important. But I think coming back to how to manage volatility in the day to day, the most important thing to remember is this too shall pass, right? The key is to be prepared to benefit for the next rally when it comes. Nobody knows when a market will hit a low or when it will hit a high, but a drop in a value of a diversified foundation allocation is a buying opportunity, right? As long as it's alongside your risk tolerance, any dip is a buying opportunity. And if you get that mentality into your mind, if you have that mentality, it should help you manage volatility and help you also achieve your long-term financial goals.
Got it. Thank you so much, Steve, for reminding us the importance to customize our different portfolio based on our investment objectives. So that's all we have for today. I hope everybody found that useful. We have included a link to our publication also on the topic Managing Volatility in the description. So, as always, please feel free to follow us on your preferred podcast app to get regular updates. Meanwhile, our views are also available on Standard Chartered Wealth Insights on YouTube, LinkedIn, and also Facebook. So please feel free to follow us here as well. Finally, if you would like to have a portfolio review, please reach out to your Standard Chartered relationship manager. Thank you so much once again for joining us and hope to chat to you soon.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.